Hello friends, welcome back to JK Shah classes. I'm Professor Nihit Jhaveri, welcoming you on behalf of JK Shah classes. Today we will be revising this chapter appearing in front of your eyes, PGBP, Profits and Gains of Business and Profession, chapter 4D. We have chapter 4A, B, C, D, E, F, 5 heads of income. Chapter 4D is PGBP, very important chapter from exam perspective. However, the marks weightage of this chapter is technically not more than 10 marks. Reason being very simple. This chapter was there at inter CA level also. You are expected to have an in-depth knowledge of this chapter at final CA level automatically. Direct questions on this chapters do not come nowadays. Chapter like minimum alternate tax, alternate minimum tax, etc. questions will come on those chapters whereby you require knowledge of this chapter. This chapter is ideally divided into two parts, income minus expenditure. So in this chapter, what we actually have to do is find out which all incomes are taxable under this head and which all expenditures are allowed under this head. Income minus expenditure will be net PGBP income. There is third part also of this chapter, which is miscellaneous provision, where we will be discussing presumptive taxation schemes, 44 AD, AE, 44 ADA, and we will also be discussing 44 AA, maintenance of books of accounts, tax audit, 44 AB, etc. So which all incomes are taxable under this head? So incomes taxable under this head, income is divided into two parts, which all incomes are taxable under this head, which all incomes are never taxable under this head. Incomes which are taxable under this head are governed by section 28 and section 41. Section 41 is called deemed profit. There are 5 incomes which are taxable as deemed profit. Deemed profit as in not actually profit of this head but are deemed to be profits. And section 28 is a charging section. There are around 15-16 incomes out here, which we have compressed into 14. Total 19 incomes taxable. However, this part is not relevant from exam perspective because whatever is covered by section 28 are something which you already know about, like profit from sale of export license, any benefit perquisite in connection with business profession, or any non-compete fees, etc., which are indirectly business income but not having regularity of nature. Then section 41 we will be discussing at the end of the chapter. One of the section 41 series is recovery of bad debts, 41.4 we know pretty well, which we will be discussing. Which all incomes are not taxable? So there are 4 incomes which will never be taxable under this head. Number 1, dividend income. Dividend is always taxable under income from other source, irrespective of whether shares are held as stock in trade or held as investment. Remember, debentures held as investment, then debenture interest will go under IFOS. But if debentures are held as stock in trade, then debenture interest will be taxable under PGBP. So debentures, bonds, government security, it matters whether held as securities. These securities are held as investment or held as stock in trade. If held as stock in trade, then income therefrom will be under the head PGBP. If held as investment, then income will go under the head IFOS. But as far as dividends are concerned, it doesn't matter whether shares are held as investment or as stock in trade. Dividend always taxable under IFOS. Then IFHB, income from house property, winning from lottery, crossword puzzle, etc., and owning and maintaining racehorse, income from owning and maintaining a racehorse. These incomes are taxable. Dividend, winning and owning, maintaining racehorse taxable under the IFOS. Then the second part of the chapter is expenditure. Expenditures are again divided into two categories. Expenditure which are allowed to be deducted under this head, and second is expenditure which are not allowed to be deducted. Which all expenditures are allowed? Again, allowable expenditure are divided into two categories. Expenditure which are specifically allowed, expressly allowed to be deducted, and second, expenditure which are generally allowed to be deducted. So expenditure which are allowed to be deducted range between section 30 to section 36(1). There are total 37 expenditures, 20 expenditures governed by section 36(1) and 17 expenditure governed by section 30 till section 35E, which we will be discussing. Expenditure which are not specifically allowed, that is expenditure which are generally allowed, are governed by single section 37(1). Section 37(1) has got 5 conditions. If these 5 conditions are satisfied, then any expenditure which is not covered by section 30 to 36(1) will all be allowed under 37(1), generally allowable expenditure. Now coming to the second category, expenditures which are not allowed to be deducted. Again divided into two categories, expenditure which are specifically disallowed, expressly disallowed, and second is expenditure which are generally not allowed. Expressly disallowed are governed by section 37(2)(b) till section 43(b), and expenditures which are generally not allowed are again governed by the same section 37(1). If any of these 5 conditions not satisfied, then that expenditure will be generally be disallowed. Okay, now starting with incomes which are taxable under this head. Incomes which are taxable under this head are governed by 2 things. Section 41 we will discuss at the end. Section 28 is not to be studied. Section 28 is charging section, which talks about certain incomes, but that was relevant from inter-CA point of view. While doing regular class, we discuss everything in detail, but in the revision lecture, this is not relevant from exam perspective. That's why we are skipping it. Then second part, income which are not taxable under this head, 4 incomes. Which 4 incomes? Number 1, HP rent, house property rent. Now, house property rent is ideally always taxable under the head income from house property. However, subject to only one exception, which is based on Supreme Court decision. Supreme Court in 3 different cases in 2015, 2016 and 2017, Supreme Court stated that it is a Supreme Court decision, stated that if more than 50 or 50% of the income, 50% or more than 50% of the total income of the assessee comprises of house property rental income, then house property rent can be offered to tax under the head PGBP. It can be offered to tax under the head PGBP. 3 case law, Chennai Properties and Investment, Supreme Court 2015, Raila Corporation 2016 and Raj Dadarkar and Associates 2017, all 3 Supreme Court decisions. However, Supreme Court decisions were all 3 reversed by Nirmala Sitharamanji in the current budget for AY 25-26. Now onwards, AY 25-26 onwards, explanation 3 has been inserted to section 28, charging section, stating that house property rental income, if it is a residential property, if it is a residential house, not the commercial house, if it is residential house, then rental income will always be taxable under the head IFHP, not taxable under the head PGBP, come what may be. How it used to make a difference? So now the things are clarified. Earlier, there was a puzzling situation. If the rental income is offered under the head IFHP, then what will happen? If offered under PGBP, then what will happen? If it is offered under the head PGBP, then actual rent will be taxable, whatever rent is actually received or receivable. But if it is taxable under IFHP, then notional income is taxable, which is called as gross annual value. We know pretty well. Whereby method of accounting also does not play a role. Whatever is actually received for 1 year or whatever is receivable, that is to be considered. But still, what is taxable is a higher lower of 4 items: fair rent, municipal valuation, standard rent and actual rent. Had it been PGBP, only actual rent is taxable. If it is taxable under IFHP, then this notional income is taxable. Secondly, under the head IFHP, in the name of expenditure, only one thing is allowed to be deducted, which is 30% of NAV, which is allowed as a standard deduction. But if it is taxable under the head PGBP, then all actual expenditures will be allowed. All maintenance charges, depreciation, everything is allowed. Subject to condition, it is taxable under PGBP. If taxable under IFHP, then in this 30% standard deduction, everything is covered up. So it used to make a difference. In case your expenditures are more than 30% of the NAV, then advisable to, not advisable, it was not optional, it had to be offered under the head IFHP only. Because of Supreme Court decision since 2015, some people started offering it under the head PGBP also, those whose substantial income was rental income. However, now all these things are stopped by Nirmala Sitharamanji by inserting explanation 3, very clearly states that compulsorily come what may be taxable under the IFHP only. However, mind you, in this explanation 3, Nirmala Sitharamanji has used the word rent from any residential house. So if it is commercial property, then assessee will still have a scope of offering it under the head PGBP. Second income which is not taxable under this head is winning income, winning from lottery, crossword puzzle, card game, dividend income, even if shares are held as stock in trade, and last is income from owning, maintaining race horse. These 3 incomes are always taxable as IFO. Which incomes are taxable? So section 28 we are skipping, and section 41 we will discuss at the end of the chapter. Next category is expenditure. In expenditure, first category is expenditure which are specifically allowable. In specifically allowable expenditure, we have section 30 till section 36(1). 37 expenditure, whatever may be the number of expenditure. Very first expenditure is very straightforward, governed by section 30, which you know you need not study again also. Without studying also, if you go, you can answer it. Rent, 4 expenditure: rent, repair, municipal taxes and insurance. Rent, repair, municipal taxes and insurance of a building, provided that building does not mean the whole building, even a small part of the building can also be considered as a building provided it is used by assessee for his business or profession, subject to compliance with the TDS provision. If tax is deductible under section 194I on the rent or 194IB, then TDS should have been deducted. Otherwise, section 40 clause A subclause 1(1)(a) will be applicable and some part will be disallowed. Subject to TDS under 194C for repair contract, 194M for contract charges or for commission brokerage paid for acquiring building on rent. Subject to 40(a)(2), if the rent paid is to a relative or a substantial interest holder, if it is excessive, then excess will be disallowed. Subject to 40(a)(3), that is, if expenditure exceeding 10,000 is paid in cash in one single day to one single party, that is payment made otherwise by way of account pay check, account pay draft, ECS, etc., then that much will be, entire amount will be disallowed. And subject to 43B, that is 9 expenditures are allowed to be deducted which affects municipal tax in this particular section, section 30, municipal tax, which is one of those 9 expenditures which is allowed to be deducted only if payment is actually made. Same way, section 31 exactly same but applicable only for plant machinery and furniture fitting. Whatever we discuss for building, same applies here also. But for building, we said 4 expenditure: rent, repair, insurance and municipal tax. But as far as plant machinery is concerned, there cannot be municipal tax. So repair is common, insurance is common. Repair and insurance of plant machinery and furniture fitting. Municipal tax is not possible for plant machinery, it is possible only for building. Rent of plant machinery is not covered here, I mentioned also, is not covered here. Then what about a rent paid for acquiring plant machinery on hire? Then that will be allowed as a deduction, but not under section 31. Instead of section 31, it will be allowed under 37(1) generally allowable expenditure, right? So it will be allowed, but don't worry. Next is very important, depreciation, section 32. What is depreciation? You know pretty well. Depreciation is allowed under Income Tax Act only on block of assets under WDV method, except in case of power generating unit who can claim depreciation under SLM method. 2 conditions to be satisfied, then only depreciation is allowed. Assessee should be the owner of the asset, either entirely on his own or jointly with other people. If he is a joint owner, then whatever is his share in the depreciation, that much will be allowed. Second is, assessee should be using that asset for his business or profession. 2 types of usage. First condition, assessee should be the owner. Second condition, asset should be used in the business or profession. That means no depreciation on personal assets. Asset should be used in the business profession. There are 2 types of usages. There is passive usage and active use. Active use means actually used, and passive use means asset is ready to be used. Like for example, I generally give example of power generator. Power generator or what do you call UPS, uninterrupted power supply, that is connected with the electrical fittings, but that will be used or actually used only when there is a power failure. Assuming there was no power failure all throughout the year, that means the UPS ultimately was unutilized. Whether depreciation should be allowed or not, answer, since it was ready to be used, it was connected, therefore depreciation will be allowed. It will be called as a passive use. Depreciation, points to be noted, is allowed on block of assets defined in section 2 clause 11. 1st April 2021, after Corona, amendments were made. Depreciation no more will be allowed on goodwill, whether goodwill of business or profession. Goodwill of business profession will not be eligible for depreciation, that is removed from the block of asset. Means no depreciation on goodwill on or after 1st April 2021. It's a 3-4 year old amendment, no need to remember the date. Second, depreciation will start from the year in which asset is put to use and not necessarily from the year of acquisition. Acquired today, started using from next year, put to use from the next year, which could be active use or which could be passive use. So even if ready to use is called put to use, then depreciation will be allowed from the year in which put to use. What are the rates of depreciation? Rates of depreciation are not given in Income Tax Act, are given in income tax rules. After the income tax rules are over, there are 2 appendix, Appendix 1, Appendix 1A. Appendix 1 talks about rates of depreciation under WDV system and Appendix 1A talks about rates of depreciation under SLM method. SLM method is allowed only by those people who are into business of power generation or power distribution and transmission. WDV method rates are given in Appendix 1. most important one is plant machinery, 15%, including motor vehicle. Then, however, if the same motor vehicle is used in the business of running it on hire, that is motor buses, lorries, taxis, etc., then double depreciation is allowed. Instead of 15%, depreciation rate will be 30%. Otherwise, for plant machinery, you will have to remember normal standard rate of depreciation is 15%. Building 10%, you will have to remember. Assets are divided into 4 blocks, and these 4 blocks are further classified into various subcategories. However, if the building is used for residential purpose, like staff quarter for staff, company owns the building, but it is used for residential purpose, not for office purpose, not as a factory, but for residential purposes of the staff, then depreciation rate will be 5%. But if the building is a temporary structure, then like in TV serials and movies, they construct some building which is held for temporary period, then temporary structure, then 40%. If it is computer, which is very important, 40%. This I am sure you remember by heart otherwise also. Furniture fitting 10%, books and periodicals 40%. This furniture fitting you will have to remember, plant and machinery you will have to remember, building you will have to remember, computer is the most important. Then books and periodical 40%, oil well 40%, intangible assets you will have to remember 25%, windmill 40% and pollution control equipment 40%, ships and aircraft 20%. Okay, if the asset is put to use, very important point, asset is put to use for less than 180 days in the year of acquiring it, then only half year's depreciation will be allowed. Even if put to use on 31st March, last day, used only for 1 day, then also half depreciation. Under Income Tax Act, there is no concept of pro rata depreciation or proportionate depreciation. There are only 2 possibilities, either full depreciation or half depreciation. There is no other possibility. So, if put to use for less than 180 days, but mind you, put to use for less than 180 days in the year of acquisition. If acquired in year 1 and put to use in year 1 itself for less than 180 days, then claim half year depreciation. However, this condition does not apply, or this proviso does not apply if acquired in year 1, year of acquisition is year 1 and put to use in year 2, and in year 2 it is put to use for less than 180 days, then even though it is put to use for less than 180 days, then also full depreciation will be allowed. Remember it, this half depreciation concept is applicable only if 2 conditions are satisfied, put to use for less than 180 days and that too in the year of acquisition itself. Then only half year depreciation, otherwise full year depreciation. Next year onwards full depreciation and no depreciation in the year of sale. Why no depreciation in the year of sale? Because of the format. Format divided into 3 points, opening WDV or the cost of acquisition of the asset, opening plus purchase minus sales, and thereafter on the balance amount we claim depreciation. So, when we come to depreciation, the depreciation at the appropriate rate is allowed on that much amount which is balance left out after subtracting asset which is sold. So, when you come to depreciation, the asset which is already sold is already adjusted, already subtracted. Therefore, automatically no depreciation will be allowed on the given asset in the year of selling that asset as per the format automatically. It is mandatory to claim depreciation. So, even if assessee does not wish to claim depreciation, then also he has to claim. If he does not claim, then AO will adjust the depreciation from the WDV. So, next year if your WDV was 100 lakh, opening WDV was 100 lakh, depreciation at the rate of 15% should have been 15 lakhs. Next year you should be getting depreciation on 85. Even if you don't claim depreciation for year 1, still next year AO will allow you depreciation on 85 lakh. He will not allow you to claim full 15 lakh. Whatever is the depreciation now. That is what we mean when we say depreciation is mandatory. Only WDV method is allowed. SLM method is allowed only to those people who are into power generating, electricity company, BSES, Tata Power, Reliance Energy, Adani Power. In case of leased asset, which is an important point, leased asset, there are 2 types of lease and there are 2 parties, lessor and lessee. Lessor is the owner, lessee is the tenant. Lessor and lessee, who will claim the depreciation? According to AS 11, accounting standard AS 11, if it is operating lease, then lessor will claim the depreciation, person who is the owner. And if it is finance lease, then lessee becomes the owner, lessee will claim. In case of AS 11, as per AS 11, 2 types of lease, operating lease, finance lease. In case of operating lease, lessor will claim, and in case of finance lease, lessee will claim as per AS 11. However, as per CBDT circular of 2001, under Income Tax Act, it is always the lessor who will be claiming depreciation because he is the owner. Whether it is finance lease or operating lease, irrespective of the type of lease, lessor only will claim the depreciation as per CBDT circular. Next point is there is a change in the ownership. Then 6th and the 7th proviso to section 32(1), if there is a change of ownership because of amalgamation, succession, demerger, etc., one person who was owning the asset, now second person comes up in the picture, then till last year depreciation would have been claimed by predecessor. Next year onwards depreciation will be claimed by successor. But for the year of amalgamation, year of succession, year of business reorganization, for the current year, depreciation will be allowed to the person who's a successor? No. Only for depreciation, remember it very clearly, only depreciation, the rules are slightly off the track. Here, depreciation will be allowed to both the parties, successor also and predecessor also, in the ratio of number of days for which the asset was used by each of them. Okay, that is an important point, keep it in your mind. Number of days in the ratio of number of days for which asset was held by them or used by them during that given previous year. Remember, the bifurcation is to be done having regard to the number of days and not number of months. Once institute asked the question that amalgamation takes place on 1st January 2025. So what many people did, they divided depreciation into two parts as 9 months and 3 months, which is in a way correct, but this is not the correct answer. It will give you a different answer. Bifurcation between predecessor and successor is not to be done in the ratio of number of months having regard to, but is to be done having regard to number of days. Number of days, how many days? So earlier party, the successor would have used it for January 31 days, February 28 days and March 31 days, would have used it for 90 days. 90 days and the predecessor must have used it for 275 days. So 275 days is to 90 days will be different ratio as compared to 9 months is to 3 months. 9 months, 3 months will be a wrong answer, slightly different answer, but that will be wrong answer. Institute asked question on this point twice. Latest question was asked in the form of MCQ, so be careful about it. Keep it in your mind. This is an important point. Next point is unimportant. It says extra depreciation on motor vehicle. Normally, motor vehicle is not separately covered. Motor vehicle is considered as part of plant machinery. And being plant machinery, rate of depreciation is 15%, but extra 15% will be allowed in case if motor vehicle was acquired and put to use. Purchase and put to use, both the conditions to be fulfilled between 23rd August 2019 till 31st March 2020, which happened before Corona. To give a boost to automobile industry, government came out with this extra depreciation. Instead of 15% on a normal motor car, 30% will be allowed if acquired as well as put to use between so and so date, which you need not remember, it is unimportant point, and that extra depreciation will be allowed lifetime. It's not a one-time exercise, not only for that particular year, not financial year 1920, but lifetime extra depreciation will be allowed. In case if it is put to use in or used in the business of running it on hire, then 30% is allowed, double depreciation allowed, plus 15%, 45% will be allowed. That is all. Then before we proceed further, let me clarify, section 32 subsection 1 clause 1 is SLM method of depreciation. Clause 2 is WDV method of depreciation, and apart from this, clause 2A, that is additional depreciation. Additional depreciation which we are going to discuss, which is an important concept from exam perspective, available only on plant machinery, and that too new plant machinery. Second hand plant machinery not eligible. It is allowed at the rate of 20% of the cost of acquisition, purchase price, and it is allowed only once. Once full 20% is claimed, it is no more allowed lifetime. And in case in the year of acquiring the asset, if it is put to use, acquiring plant machinery, it is put to use for less than 180 days, then 20% will be allowed as 10% in year 1, half will be allowed in year 1 and balance half will be allowed in year 2, right? And it is depreciation only, but called as additional depreciation. Additional depreciation not allowed to those people who have opted for 115BAA, domestic company opting for 22% tax rate, or 115BAB, domestic manufacturing company opting for 15% tax rate, or 115BAC subsection 1A applicable to individual HUF, AOP, BOI and artificial juridical person, new tax rates or new tax regime, NTR I call it as. Similarly, 115BAD and BAE applicable to domestic cooperative society, resident cooperative society which is opted for 22% tax rate or 15% tax rate, then these people cannot claim additional depreciation. However, normal depreciation will be allowed, and this point we discussed in special rates of tax chapter also. And in case you have yet to view that chapter or video of special rates of tax, then just to remind you, then here you are discussing for the first time. However, 20% on the new plant machinery, it is allowed to all assessee, individual HUF, AOP, BOI, partnership firm, company, LLP, but allowed only if assessee is engaged in manufacturing business or at the max generation of business of generation, transmission or distribution of power, GTD of power. 20% is allowed. Manufacturing includes printing also, printing of textbooks, printing of books or printing and distribution of books as per CBDT circular. This is not given in the Act. However, remember, printing of books is not considered as manufacturing for the purpose of section 115 BAB and 115 BAE. 115 BAB and BAE 15% tax rate is allowed only to manufacturing domestic company or manufacturing resident cooperative society. Here, for the purpose of these two sections, manufacturing does not include printing of books. However, for the purpose of 32(1) clause 2A, additional depreciation, manufacturing includes printing of books. This is slightly off the track point. Keep it in your mind. Our institute, I have found, history of institute says that institute is always interested in asking questions on these tricky points. Okay. If this new plant machinery is put to use for less than 180 days, then only 10%, that is half of 20% will be allowed in the current year, balance half will be allowed next year. 5 assets or 5 plant and machinery are blacklisted. Here additional depreciation not allowable on 5 plant machinery. Normal will be allowed, additional not allowed. Number 1, ships, aircrafts or road transport vehicle. So ideally it is allowed additional depreciation if you understand the background, understand the concept, why government allows extra depreciation. Answer, idea is to give a boost to manufacturing segment and power generating segment. So government says here only those plant machineries are eligible which are ultimately used inside the factory and not on the road. Road transport vehicle, motor car, bus, taxi, lorry, etc. or ships or aircraft, they are plant and machinery, but they will not be eligible for additional depreciation. However, will be eligible for normal depreciation. Second is very important, previously used plant machinery, that is second hand plant machinery. Here for second hand there are no exceptions. Just for the, since you are already done with the chapter and we are revising it, no exceptions. If you recollect, in section 35 AD, 14 specified businesses, cross-country pipeline network, agricultural warehouse, cold chain facility, hotel of 2-star and above, hospital of 100 patient beds and more. 35 AD, there also there is a condition that second hand is not allowed. 10 AA SEZ, there also second hand plant machinery not allowed. And even for 115 BAB, manufacturing company, domestic company, 15% tax rate, and 115 BAE for resident cooperative society engaged in manufacturing. These 1, 2, 3, 4, these 4 places also second hand plant machinery not allowed, but at these 4 places there are 2 exceptions. There are 2 exceptions. Out of these 2 exceptions, we will be discussing, out of these 4 sections, these 2 exceptions will be discussing in 35 AD. Which 2 exceptions? If the second hand plant machinery is imported from a country outside India or the value of second hand plant machinery does not exceed 20% of the value of total plant machinery, then second hand will not be considered as second hand. Previously used will not be considered as previously used. These 2 exceptions are there for these 4 sections but not there under section 32(1) clause 2A for additional depreciation. Here no second hand means no second hand, no exception. Third and fourth, plant machinery which is to be installed in any office premises or residential accommodation including a guest house, then it will not be. I already told you the idea behind 32(1) clause 2A additional depreciation. Idea is to give a boost to manufacturing industry. Therefore, only those plant machineries will be eligible which are used inside the factory. Next is office appliance. Office appliance like computer ideally, but the same office appliance is used inside the factory, then it is allowed. Computer or a laptop which is connected with other plant machinery inside the factory, then it will be eligible for additional depreciation. Same laptop is used inside the office, then not eligible. Last one, any plant machinery whose entire cost of acquisition is fully allowed as a deduction, 100% write-off is allowed, whether by way of depreciation or otherwise. Or otherwise would mean like sections like 35 AD, 35 CCC, 35 CCD, agricultural extension project, skill development project. Under some section, if the 100% of cost of acquisition is allowed as a deduction, then you can't claim depre also and you can't claim additional depre also. Forget about additional depre, even normal depre also will not be allowed for a simple reason, it will amount to double benefit, double deduction. You bought an asset for 10 lakh rupees, you are already getting deduction of full 10 lakh rupees, then how can you claim depreciation again? It will amount to double deduction. Additional depreciation not allowed if assessee has opted for 115 BAA, BAB, BAC 1A, BAD, BAE. 22% tax rate for domestic company, 15%, 22% tax rate for resident cooperative society, 15% tax rate for resident cooperative society, and 115 BSC subsection 1A is new tax regime applicable to individual HUF, AOP, BOI and AJP. Section 32 subsection 2, unabsorbed depreciation. This we know pretty well. If the depreciation of the current year remains unabsorbed, then it can be carried forward to the next year. That way it can be carried forward for an unlimited period of time, unlimited as compared to 8 years and 4 years. However, depreciation or unabsorbed depreciation brought forward of earlier year or current year depreciation is not allowed against three types of income, not allowed to be set off against salary income. Second, winning income, winning from lottery, crossword puzzle, card game, salary, winning, and third is again gain from virtual digital asset, which is capital gain. So, depreciation of the current year or the brought forward unabsorbed depreciation cannot be set off against these three incomes. Barring these three, it can be set off against any income. So, even if depreciation, unabsorbed depreciation is a part of PGBP chapter, it can still be set off against capital gain. It can be set off against PGBP income, IFHP income, anything. Balance to be carried forward, and in the next year also for unlimited period, next year also or subsequent years also it will be allowed to be set off subject to same rules regulation. SLM method 32 subsection 1 clause 1. As I already told you, 32 subsection 1 clause 1 is SLM, clause 2 is WDV, clause 2A is additional depreciation. Now clause 1 SLM, who is allowed for SLM, who is eligible? Answer: those who are into power generating business or generating and distributing. Allowed only on tangible assets, not allowed on intangible. As far as intangible assets, even for power generating units also like BSCS, Tata Power, Adani, Adani Power, Adani Energy, whatever is the name, they are also allowed SLM method of depreciation only on tangible assets, not on intangible assets, because for intangible they will have to claim WDV method. Okay, allowed only to those engaged in generation, distribution of power. If there is a profit on sale, what will happen? If there is a loss on sale, what will happen? It is a profit on sale, then profit ideally should go under the head capital gain because it's an asset. However, some part of the profit will go under the head PGBP and some part of the profit, excess profit, will go under the head capital gain, and if there is a loss, entire loss will be allowed under the head PGBP. Here, there are some technical terms used which already asked by institute in the form of MCQ, can be asked again also, just keep it in your mind. This section is not very important because SLM method is not allowed to everyone. It has a very limited applicability, applicable only to power generating unit. How many power generating units are there or how many power generating companies are there in the country? Hardly few. So not applicable. Here, technical terminology we were talking about. If there is a profit, profit is called as balancing charge, and if there is a loss, it is called as terminal depreciation. Let's try to understand with the help of an example, how does it work. So, suppose any plant and machinery is acquired or cost of acquisition of asset is 100 lakh under SLM method, and suppose any rate of depreciation is 10%. So, depreciation is already claimed for 3 years, year 1, year 2, year 3, at 10%, 10 lakh, 10, every year depreciation will be same. Under WDV method, we claim depreciation on block of asset. Under SLM, we claim depreciation on each asset individually and not under block of asset concept. Okay, so 30 lakhs is already claimed up till now. WDV drops down to 70 lakh rupees, 100 minus 30. We don't call it as WDV. WDV is a wrong word because we are not following WDV system. It's called balance unabsorbed, which is 70 lakh rupees. How much is already claimed? 30 lakhs is already claimed as depreciation under SLM method. Now this asset is sold. Two possibilities: sold at profit, sold at loss. What do you mean by sold at profit? Sold at profit means sold for more than 70 lakhs because now the cost has dropped down from 100 lakhs to 70 lakh. Cost will be 70 lakh and not 100 lakh, original cost not to be taken into account. Second possibility is sold at a loss. Sold at loss means sold for less than 70 lakh. So let's say now it is sold for 48 lakhs. Sale consideration is 48. That means sold for loss. Minus what? Minus 70 lakhs. Cost of acquisition is 70 lakh. Due to space constraint, I have used the word WDV for this 70 lakh. WDV is a wrong terminology. You should use the word balance unabsorbed. So 22 lakh is a loss. Out of 22 lakh, what will happen? 22 lakh entire loss will be allowed under the head PGBP allowed instantly in the same year in which the asset is sold will be called as terminal depreciation entirely under the head PGBP. Nothing will go under the head capital gain. But if it is sold at a profit, that is sold for more than 70 lakh, then two possibilities: sold for let's say 78 lakh, that is sold for more than 70 but less than original cost of 100, minus 70 lakh is the cost of acquisition, 8 lakh is a profit. This entire profit will be called as balancing charge, will be taxable under the PGBP entirely. But if it is sold for more than 70 but as well as more than 100 also, more than original cost, let's say sold for 108, then minus 70 cost, 38 lakh is a profit. Then out of 38 lakh, to the tune of whatever was claimed as a depreciation under section 32(1) clause 1, that much out of 38 lakh rupees of profit, first 30 lakh of profit will be called as balancing charge, will be taxable under the PGBP, and balance 8 lakh excess profit will be taxable under the capital gain. There are two ways of finding out this 8 lakh. One way is that this total profit minus deduction already claimed under this head, under this section. That is our 8 lakh. Another option, another possibility is sale proceeds is 108 lakhs minus original cost is 100 lakh. Any sale proceeds received above and over the original cost will go under the capital gain. There are two ways to find it out. Answer is 8 lakh. 8 lakh will go under the head capital gain, and up to 30 lakh rupees profit will be taxable under the head PGBP under section 41 subsection 2 as balancing charge. Okay, PGBP it will be called as balancing charge, and section 41(2) is nothing but deemed profit, which we will be discussing towards the end of the chapter when we are done with almost entire chapter. Coming back, our next two deductions are 33AB and 33ABA. 33AB is Tea Coffee Rubber Development Account, TCR. Tea Coffee Rubber Development Account, a special account opened with NABARD, National Bank of Rural Agricultural and Development Account, NABARD. And the 33ABA is deduction on account of depositing funds in Site Restoration Fund account, SRF account to be opened with either State Bank of India, special account with State Bank of India. Here account to be opened with NABARD, and here account to be opened with either State Bank of India or special account with Ministry of Petroleum and Natural Gas. Ministry of Petroleum and Natural Gas. Both the sections are less important from exam perspective. They're not that great. Hardly any question would have come in the exam. These deductions are allowed to both all assessee. So first point is who is the eligible assessee? Answer any person, provided that person is engaged in growing and manufacturing, both the businesses, growing plus manufacturing of tea, coffee, rubber in India, not outside India, in India, and that too both the businesses. If he is only into growing of tea, coffee, rubber, then entire income could be exempt under section 10 clause 1, that is agricultural income. If he is into growing plus manufacturing, then only this section is applicable. Here deduction is allowed to the tune of whatever amount is deposited in this tea, coffee, rubber development account with NABARD. Open a special account. Here deduction is allowed not based on accounting entry. Here money will actually go out of the pocket of assessee. Assessee will have to actually make payment to the third party. Deduction will be lower of the following two: either actual amount deposited in this account with NABARD within 6 months from the end of the relevant previous year, that is after 31st March 6 months, that is by 30th September, or on or before the due date of filing IT return, whichever is earlier, 6 months from the end of the previous year, or on or before the due date of filing IT return, whichever is earlier, or 40% of the profits. This you'll have to remember. It can come in the form of MCQ. That's why slightly important. Otherwise, don't expect any full-fledged 5 marks worth of question. Don't expect any practical or descriptive question. It can come in the form of MCQ, where you'll have to remember 40%. Deduction is allowed to all assessee, individual, HUF, AOP, BOI, company, firm, LLP, provided assessee is engaged in growing as well as manufacturing of tea, coffee, rubber, both growing plus manufacturing. 40% of the profit from such business, that means not the 40% of total income or not the 40% of PGBP income, 40% of only income from such activity, such business of growing and manufacturing tea, coffee, rubber. However, it should be 40% of such a profit which is calculated before claiming this deduction. Obviously, this deduction, so we are calculating how much is allowable. So the profit figure which we are taking into account should be before claiming this deduction, before claiming chapter 6 deduction, before claiming exemption under section 10(1), before claiming this deduction, before set off of brought forward losses, and before claiming exemption under 10(1). Next is section 33ABA. 33ABA is again allowed to all assessee, any person, provided engaged in the business of prospecting for extraction of or production of mineral oil, petroleum or natural gas, prospecting for extraction of or production of petroleum, natural gas in India. Even tea, coffee, rubber should have had been growing and manufacturing should have had been in India. Here also prospecting for extraction of or production of mineral or petroleum crude oil should be in India. Deduction will be lower of the following two. Here also, just like previous section, here in the previous section account had to be opened with NABARD. Here the account has to be opened with State Bank of India or Ministry of Petroleum and Natural Gas. Either amount deposited in special account with State Bank of India, in SRF account, or with Ministry of Petroleum and Natural Gas. However, time limit to deposit is slightly different. Here in the previous section, time limit to deposit was 6 months from the end of the previous year or on or before the due date of filing IT return, whichever is earlier. Same way here, time limit is slightly different. Here the amount to be deposited on or before the end of the previous year. Before the end of the previous year. In the previous section, 6 months from the end of previous year. Here by 31st March itself only. Or 20% of profit from such business before claiming this deduction and before claiming set off or brought forward loss. In the previous section, we said before claiming set off or brought forward loss, before claiming this deduction and before claiming 10(1). 10(1) is possible only for tea, coffee, rubber. Section 10(1) exemption is not possible for petroleum and natural gas in India. Right. Now, common points. Here, deduction is allowed to all assessees subject to CA certificate. CA certificate will have to be furnished along with or 1 month before the due date of filing IT return. See, without CA report in form number 3AC, deduction is not allowed. That is okay. That's not an important point from exam perspective. Common points. Whether funds deposited in this account or transferred to this account, NABARD or State Bank of India or with Ministry of Petroleum and Natural Gas can be withdrawn or not. Answer: can be withdrawn only for specified purpose, cannot be withdrawn for non-specified purpose. But if withdrawn for specified purpose, it will have to be spent by the end of the same previous year in which funds were withdrawn. Otherwise, unspent amount will become taxable in the same year. In case if the amount is withdrawn and spent also in the same year, but can it be spent for capital expenditure? Can an asset be acquired? Answer: yes, asset can also be acquired. It can be spent for revenue purpose also. It can be incurred for acquiring capital asset also. But by the end of the same previous year, otherwise there could be trouble. It will invite unnecessary trouble. In case withdrawing on 30th March, 31st March, then don't do that. Withdraw it on next day, 1st April. So year gets changed. If withdrawn, then an asset is acquired, utilized to acquire asset, then it is allowed. But other than following 4 assets, if following 4 assets which are prohibited asset, blacklisted asset, without any exception, then cost of acquisition will be taxable. So amount withdrawn is 100 lakhs, 1 crore. Out of 1 crore amount withdrawn, 25 lakhs is spent for acquiring any of these 4 assets. Then entire 25 lakh, whatever is the cost of acquisition of these 4 assets, will become taxable instantly. Out of these 4, 2 of them are common with what we discussed with the exceptions that we discussed in additional depreciation. There were 5 exceptions, 5 blacklisted plant machinery. Which 5 blacklisted? Ship, aircraft, road transport vehicle, second-hand plant machinery, that is previously used plant machinery, any plant machinery which is to be installed in office premises, residential accommodation or guest house, any office appliance, and last one was any plant machinery whose entire cost is allowed as a 100% write-off by way of depreciation or otherwise. Out of those 5, 3 of them are reproduced here. But sir, there are 4 items, no? Answer: yes. 4th item is a new item, extra asset which is blacklisted. 3 of them are common with additional depreciation. Which 3? Plant machinery which is to be installed in office premises, residential accommodation and guest house, which was there also. Any office appliance other than computer, which was there also in additional depreciation. And any plant machinery which is eligible for 100% write-off, 4th one. These 3 were common with additional depreciation. One extra item is here which was not there for additional depreciation, that is any plant machinery which is to be installed in an undertaking, such a factory which manufactures low priority items, which are given in 11th schedule. Like low priority items, 11th schedule, no need to refer to, but just for the sake of your knowledge, just to satisfy your curiosity, low priority items are shampoo, soap, perfume, deodorant, body spray, such kind of items which are luxurious items, or those which are hazardous to human life, that is tobacco products, pan masala, cigarette, BD, plastic carry bags less than 20 microns, etc. Such products are called as low priority item. Any plant machinery which is installed in such a unit or such an undertaking which manufactures low priority items given in 11 schedule, then that will not be eligible. Cost of acquisition of such plant machinery will instantly be taxable. If the withdrawn amount is used for acquiring an asset other than the above 4 which is allowed, then the given asset will have a lock-in period of 8 years. For next 8 years, such asset cannot be sold. 8 years of lock-in period from the end of the year in which asset was acquired, subject to 2 exceptions. If transferred to government, then no problem before expiry of 8 years, or transferred by partnership firm to a company when the partnership firm gets converted into company, and that is how partnership firm transfers to company before expiry of 8 years, then no problem. Barring that, lock-in period of 8 years. If lock-in period is breached, then what will happen? Then cost of acquisition of such asset to the tune of deduction already claimed under this section will be taxable in the year of transferring it before expiry of 8 years. Last point, 33AB and 33ABA, both of them are not allowed to those people who have opted for special scheme under 115BAA, BAB, BAC subsection 1A, BAD and 115BAE. These people are not eligible to claim this deduction. Same point we discussed in chapter 12 also, special rates of tax, where we discussed these sections in detail. 35ABA and 35ABB and 35ABB both are same, exactly same, but are given differently. One is spectrum fees which is airwaves, internet, that internet spectrum, okay, airwaves, but 5G, 4G, 3G, etc. And the second one is telecommunication license fees. Both of them are deductions are allowed. They are in the nature of capital expenditure practically. So if Vodafone, Reliance Jio, etc. have paid 50,000 crore to government, that is Telecommunication Regulatory Authority, TRAI, or maybe to Telecommunication Department, government, Vodafone Idea, etc. have paid 50,000 crore rupees, which is ideally a capital expenditure, then also deduction will be allowed under this section in equal installment. Assessee could be any person. Deduction will be in equal installments spread over the life of the license or life of the spectrum or license, meaning thereby deduction is allowed in equal installment. But so if the license is for 10 years, then deduction will be in 10 installment. However, understand very carefully from which year deduction will start. So answer, 10-year period or whatever is a period of license, deduction will start either from the year in which business commences or the year in which payment is made, year of payment or the year of commencement of business, whichever is later. Please remember this very important point, whichever year is later. So in case if, so I had given one example if you recollect, in case if license fees is 9,000 crore rupees, 9,000 crore, and the life of the license is 10 years, then ideally logically you will feel that it should be 900 crore rupees per annum deduction into 10 years. Agreed. That is what will happen, per annum 900 crore into 10 years, agreed. But in case if the business does not commence from year 1, payment is made, payment happened in year 1, but business commences from year 2. Which business? Business of telecommunication or internet. Business commencement is year 2, then deduction will be allowed from year 2 till year 10. And year 2 to year 10, that means 9 years are left. Then 9,000 crore divided by 9 years, deduction will be 1,000 crore per annum into 9 years. 1,000 crore per annum into 9 years. So be careful about it. It's not always just because a license is of 10 years, that doesn't mean deduction has to be 900 crore into 10 years. It could be 1,000 crore into 9 years also. So be careful about it. We had taken similar example in regular class. No depreciation will be allowed. So here license fees or a spectrum fees is ideally in the nature of an intangible asset on which depreciation rate is 25%. But depreciation will not be allowed because you are claiming this. However, government has not clarified as to whether this section 35 ABA, ABB versus depreciation section 32(1), whether these are optional or compulsorily one has to claim deduction under this section only. Nobody knows. Ideally, people end up claiming here. If a question comes in the exam, don't claim depreciation, compulsorily claim this only. Okay, if amalgamation or demerger takes place before expiry of this 9-year period or 10-year period, then what to do? Then here deduction will be, understand very clearly, unlike depreciation, deduction for earlier years will be allowed to the predecessor, deduction next year onwards will be allowed to the successor. Agreed. Problematic child is only the year of amalgamation or the year of demerger. Who will claim for that year? The answer for that year, deduction will entirely be allowed to the successor nothing allowed to the predecessor. Had it been depreciation, then depreciation is the only expenditure which for the year of business reorganization will be partly allowed to predecessor and partly to successor in the ratio of number of days, as we discussed here, in the ratio of number of days allowed to both of them had it been depreciation. Except of depreciation, all other deductions under this chapter for the year of business reorganization entirely will be allowed to the successor, nothing will be allowed to the predecessor. So it will go this way. So suppose there are 10 years, deduction is allowed for 10 years. In a 7th year amalgamation takes place, then for first 6 years deduction would be allowed to amalgamating company predecessor. Next year onwards, the last 3 years deduction will be allowed to the amalgamated company successor. Problematic child is only the year of amalgamation. Even if amalgamation takes place on the last day, 31st March, then also entirely will be allowed for this year, entirely will be allowed to the amalgamated company, successor company. In case of demerger, it will be allowed to the resulting company. Simply, successor will claim the deduction and not the predecessor. Not a single rupee will be allowed to predecessor. Had it been depreciation, then it would have been allowed to both of them individually. Okay, then if license or spectrum is sold, two possibilities, 100% license is sold or part of the license or spectrum is sold. What to do? Understand very carefully. If entire spectrum is sold or transferred, then what will happen? Just like SLM depreciation, two possibilities, sold at profit, sold at loss. When can it be at profit? When can it be at loss? So suppose any license is acquired or the spectrum is acquired for 100 crore rupees, that is the cost of acquisition, and deduction is allowed over a period of 10 years supposingly, then at the rate of 10% per annum, first year it would be 10 crore, second year 10 crore, third year 10 crore, up till now 30 crore is already claimed, and the balance left out, balance unabsorbed is 70 crore. Then just like SLM method of depreciation, here 70 crore will be the WDV, but we will not call it as WDV, we will say balance unabsorbed. For a reason, we are not claiming depreciation. Since depreciation is not allowed, you cannot call it as WDV. Now if the license is sold entirely, 100% license is sold, two possibilities, sold at profit, sold at a loss. If sold at a loss, that means sold for less than 70 crore. That means sold for, let's say, 48 crore minus 70 crore is a cost of acquisition, that is WDV. 22 crore is a loss. This loss will entirely be allowed as a deduction under this section in the year of transfer itself. Sold at a profit, second possibility. Profit, that means sold for more than 70 crore. Again, two possibilities in profit, just like SLM depreciation, sold for more than 70 crore but less than 100 crore. Or second possibility is sold for more than 70 crore as well as more than 100 crore. So sold for, let's say, 78 crore minus 70 crore is the cost of acquisition, 8 crore is a profit, entirely taxable under the PGBP. If the profit is up to 30 crore, whatever is the deduction claim, up to 30 crore of profit will be taxable under the PGBP. Any profit more than 30 crore, more than the deduction claim, will go under the capital gain. So let's say sold for 108 crore minus 70 crore is a cost, 38 crore is a profit, 30 crore, first 30 crore will go under the PGBP and balance 8 crore under the capital gain. This is the story if 100% license is sold, entire license is sold or entire spectrum is sold. If entire spectrum is not sold, a part of the spectrum is sold, let's say 40% is sold, 60% is left out. Then in such situation what to do? Then first of all, ignore the percentage which is sold, irrespective of the percentage sold. Only for namesake we have sold 40%. Otherwise, whether sold 40%, 45% or 60% makes no difference. This 40% is not to be applied anywhere. Simply, same example, 100 crore is the cost of acquisition of license, 30 crore is a deduction claim up till now in 3 years, 10 crore each year, 70 crore is a balance WDV, which we will not call it as WDV, we will call it as balance unabsorbed. If part of the license, let's say 40% of the license is sold, two possibilities, sold at a loss, sold at a profit. If sold for profit, no, then let's first understand that two possibilities, sold for more than 70 crore but less than 100 crore, and second, sold for more than 70 crore as well as more than 100 crore. Sold for 78 crore minus 70 crore is a cost, 8 crore is a profit, entirely taxable under the PGBP. Here it makes no difference whether 100% license is sold or 40% license is sold. Same way, sold for 108 crore minus 70 crore is a cost of acquisition, 38 crore is a profit. Here also same thing, 30 crore will go under the PGBP and 8 crore excess profit will go under the capital gain. Here also no difference whether 100% license is sold or 40% license is sold. 100% is sold or part of the license is sold will make a difference only and only when there is a loss. So loss is possible only if sold for less than 70 crore. Say if sold for 48 crore minus 70 crore, 22 crore is a loss. Here this 22 crore Unlike 100% license sold, where 22 crore was going to be allowed as a deduction entirely allowed as a deduction in the year of transfer itself. When 40% license is sold or part of the license is sold, this 22 crore loss will not be allowed in one go. It will be allowed in installments. The balance installment or balance period of license or balance period of spectrum, as the case may be, allowed as a deduction in installment. Supposing 3 years are left out, then 22 crore divided by 3 years, some part in the current year, some part in the next year, some part next to next year. 4 years are left out, then 22 crore divided by 4. On the other hand, depreciation will not be allowed. Just keep it in your mind. No depreciation will be allowed and treatment will be like this. Now the next is section 35. Section 35, deduction on account of expenditure on scientific R&D. Scientific R&D is defined separately, but no need to refer to the definition in section 43. However, scientific R&D expenditure is divided into two categories. Deduction is allowed only if associate has a PGBP income, because section 35 is a part of PGBP chapter. Let me explain it to you. It's divided into two categories. Number one, in-house research, that is self-spending. In case where associate has his own laboratory or some place to carry out the scientific research. And second, contribution to outsider. Person like me, I am into teaching line, which is PGBP income for me, professional income, but I don't have my own laboratory and I want some type of scientific R&D to be carried out. Then under this section, under this part 2, I can contribute to some research association, IIT, certain colleges or university or educational institution which are specialized into carrying out and which are approved by income tax department to carry out scientific R&D. Again, in-house and contribution to outsider, both of them have two more categories, 35(1), 35(2)AB, 35(1), 35(2)AA. Everywhere person could be anybody, any except of this place where the person has to be a company. Okay, this is very simple and I will tell you what all questions are asked. Up till now, up till Modi government, prior to that, this section used to be considered as a very important section, because here everywhere I divide them into 4 categories, category 1, 2, 3, 4, and everywhere there were different deductions allowable. Some places it was 100% of the amount spent or amount contributed, some places 125%, some places 150%, some places 175%, and some places 200% also, double deduction. These used to be called as weighted deduction. Now gradually Modi government came and from AY 15, 16, 16, 17 they started streamlining everything, and now all weighted deductions are gone. Everywhere it is 100% only. So now from exam perspective, you don't need to bother about where was 175, 125. Simply remember which all provisions or which all things can make a assessee eligible to claim the deduction. So starting with the first category where assessee is any person and spending in-house. Here also assessee should be company. Is there any difference? Answer yes, both the places. There is a slight difference. What is it? We will discuss. Primarily difference is that here assessee should be spending, where assessee is any person, should be spending on R&D, on his R&D related to own business. R&D related to own business. So suppose there is a company called Toyota. Toyota is into manufacturing of car. Tomorrow if they spend money on R&D, for manufacturing aircraft, then in that case that is not related to own business. If they spend money on R&D related to car manufacturing, instead of petrol car, they come out with some, or they do R&D for hydrogen car, water-based car, then it's okay. Then it is R&D connected to own business. But if it is spent on aircraft manufacturing, then it is not connected with the own business. Deduction will not be admissible. Whereas if it is a company, here company can spend it for non-related business also, for other than his own business also. But here it should be R&D should be approved by higher authority. R&D facility should be approved by prescribed income tax authority, higher authority as in prescribed income tax authority. Not authorized, I would say approved by income tax authority. Okay. So here assessee being a company can spend it for other than its own business also. So here Toyota can spend money and claim deduction even if it spends on R&D pertaining to aircraft manufacturing, provided the R&D facility was approved by department. Okay, and when they are contributing to outsiders, here two category 3 and 4, both are to be merged now. It doesn't matter whether it is category 3 or category 4, because both the places earlier, once upon a time, different percentage of deduction was allowable. Now it is same 100%, so it doesn't matter. So when it is self-spending, no, there could be two types of expenditure, revenue or capital. When you are contributing to third party, there cannot be capital expenditure, it has to be revenue expenditure. But when you are spending by yourself, there can be capital or revenue. If it is capital, then depreciation will not be allowed because you are claiming 100% of the cost of the asset. So here it should be in category 1, if it is capital expenditure, it should be other than land, and in category 2, it should be other than land and building, other than land and building, which we'll be discussing as and when we come across. So due to space constraint, I'm picking up only category 1 and 2 at a time, two categories at a time. Otherwise, you won't be able to see it on the screen. Okay. So 35 in-house research, self-spending. 35 subsection 1, assessee is any person. 35 subsection 2AB, assessee is a company. One by one. There are 2-3 fundamental differences, rest all is one and the same. Everywhere deduction would be 100%. Here assessee carries on scientific R&D related to own business on its own and incurs related to assessee's own business, then deduction would be allowed under this particular section. Here expenditure could be pre-commencement or post-commencement also. Here expenditure could have been incurred in the current previous year as well as expenditure incurred before commencement of business. That is also allowed, provided it does not exceed the period going backwards. Period should not exceed 3 years prior to the date of commencement. Not 3 years prior to the financial year in which the business is commenced, 3 years prior to the date of commencement of business. During pre-commencement period expenditure, salary to employees engaged in scientific R&D will also be R&D expenditure. Salary allowed, salary to staff engaged in R&D. But if it is perquisites to employees during pre-commencement period, whether it is 3 years or more than 3 years, that will not be allowed. It should be R&D expenditure including salary to staff, but other than perquisite to staff during pre-commencement period. If the perquisites are offered after the business commences, then it's okay, allowed. If it is revenue expenditure, then deduction 100%. If it is capital expenditure, it should be other than land, that you need to remember, which is important. Deduction will be 100%. Section number, clause number will be slightly different. 35 subsection 1 clause 1, this is 35 subsection 1 clause 4. It is also called as 35 subsection 2. 35 subsection 2. 35 2 and 35 1 4 is one and the same. Same thing is given at two different places. It is 35 1 4 which states that deduction will be as per whatever is given in 35 2, and then 35 2 talks about percentage, 100%. Second category, if assessee is a company, here assessee should be company. Then it says other than the company referred to in section 35 subsection 1 clause 2a. What is it? We will discuss in some time. 35 1 2a is a part of category 3. So when we come to category 3, I will bring you back to this category 2. So right now what is appearing in front of your eyes is category 1, category 2. There is no category in the act. Act does not say, even in institute's module also they don't say category 1, category 2, category 3 and 4. Categorization is done by me for the sake of simplicity in our understanding, so that we can easily recollect this was category 1, category 2. In exam, don't write category 1, 2, 3, 4. It is only for our understanding purpose. Important condition here, assessee should be company and not only ordinary company. Say even JK Shah classes is also a company, Veranda is also a company, but they won't get deduction under this subsection 2AB, because here the company should be either engaged in biotechnology or should be engaged in manufacturing or production of article or a thing. Manufacturing company or biotechnology company. The moment in exam, if they give you biotechnology company or manufacturing company, it should click up in your mind. Here, service providing company cannot claim. Like coaching class industry, JK Shah classes cannot claim. But JK Shah classes can claim under this category, where assessee could be any person without any further condition with regards to manufacturing. Okay. Now, that is one thing. But it should be manufacturing other than those articles which are given in 11th schedule. 11th schedule, we had a discussion in section 33AB and 33AB, tea, coffee, rubber development and site restoration fund account, whereby we discussed that 11th schedule means low priority items, which are shampoo, soap, conditioner, perfume, deodorant, body spray, cigarette, BD, tobacco, gutka, pan masala, etc. hazardous products or luxurious products, which are low priority items. So company, if the company is engaged into gutka manufacturing company, it cannot claim under 35(2)(ab. It has to claim under 35(1). 35(1) allowed, 35(2)(ab) not allowed. Once upon a time, 35(2)(ab) was 200% of the expenditure incurred, and here it was 100%. So it used to make a difference. Companies always wanted to claim under 35(2)(ab), but now everything is gone. No 200%, no weighted deduction. Deduction will be 100% of the expenditure incurred. Here, expenditure could have been incurred not necessarily on its own business. Expenditure could have been incurred It could be revenue or capital expenditure. If it is capital, it should be other than land and building. Here it was other than land. Here it is other than land and building. R&D facility should be approved by prescribed authority. Prescribed income tax authority means generally CIT, PCIT. Deduction will be 100% of the expenditure incurred, whether for revenue or capital. If it is for capital, it should be other than land building, and secondly, it should be other than depreciation. Depreciation will no more be allowed. Such expenditure should have been incurred after the date of approval of R&D facility. So here, pre-commencement period is not possible. Unlike here, where we discuss current year expenditure as well as 3 years prior to the date of commencement. Here, in second category, pre-commencement is not possible logically, because it has to be expenditure should have been incurred after the date of approval of R&D facility. Deduction in any case will be 100%. Once upon a time, Institute's favorite question was that here, assessee is a company incurring revenue expenditure on R&D facility approved by prescribed authority plus incurring capital expenditure. In capital expenditure, they are incurring on land also and building also. Land also, building also. Conditions of category 1 are also satisfied. Conditions of category 2 are also satisfied. Then in that case, revenue you claim under 35(2)(ab). Land not allowed under any circumstances. Building is not allowed under 35(2)(ab). But building can be claimed under 35 subsection 1 clause 1 or clause 4. Building can be claimed. So it is not necessary that assessee which qualifies for category 2 has to claim under category 2 only. It can claim under category 1 also. Because for category 2, it has to be a company engaged into biotechnology or manufacturing. But it doesn't mean it doesn't fall under category 1. Category 1 is for everyone. So company which falls under category 2 may fall under category 1 also, can claim deduction not for the same expenditure but for a different expenditure. Like building, it can claim under 35(1) clause 1. Okay, in category 3 and category 4, here category 3 assessee could be any person, category 4 also any person. Contribution to outsiders. Here expenditure cannot be capital, it has to be revenue only, because you are spending it to other person, for you it is a revenue expenditure. What is that person doing, that is none of your business. Okay, contributing to approved research association which has scientific R&D as one of its object. Approved research association which has scientific R&D as one of its object, 100% of the amount contributed, 35(1) clause 2. Approved university, approved college, other institution using it for scientific R&D, 35(1) clause 2, same clause, 100%. But if 35 subsection 1 clause 3, research and in social science or statistical research, then again 100%. So it doesn't matter whether spending for scientific R&D or social science research or statistical research, it doesn't matter. Everything will qualify for 100%. You just need to remember these wordings. So if a question comes, it should click up in your mind that yes, deduction is allowable here. November 24 attempt, one 5-mark question came on this. So please be careful, it's important. Don't ignore it. Right? Syllabus is so vast that you can't afford to ignore everything. You cannot have a selective approach. If you feel that this chapter question hasn't come since long, so now it is unimportant, don't do it. No, all of a sudden question will come. This is CA final, this is not CA foundation or inter CA, where you could follow some strategy. Here strategy will not work, or will work to the tune of 30%, 40% of the paper, which will make it very dicey. So don't jump to such conclusion. Or anybody guiding you on YouTube video or any other teacher guiding you that this will come, this will not come, don't jump to any conclusion. Okay. Okay, then it is approved company registered in India. You are contributing to a company which is registered in India and which is approved for scientific R&D and having scientific R&D as its main object, then you will get 100% deduction. Now let me take you back to category 2. Category 2 was for company engaged into biotechnology or manufacturing. You are contributing to a company, you will get 100% deduction. Then that company cannot get deduction under this, because here it should be company other than category 2. It should be company other than the company which is referred to in section 35 subsection 1 clause 2a. And company referred to in 35 subsection 1 clause 2a is this company. 35 subsection 1 clause 2a. Getting it? Okay. Now category 4. Category 4 is very straightforward. Category 4, there are names of 4 people. You need to remember them. National Laboratory, University, IIT, Indian Institute of Technology, and specified person approved by the prescribed authority. However, both these places, category 3 and category 4, there is no condition that the R&D expenditure should be in connection with assessee's business. That condition is only in category 1, that the R&D should be related to assessee's own business. That condition does not find place in category 2, 3 and 4. So here it's quite possible that I am into profession, I am contributing to IIT, I want them to do some R&D. R&D may not be related to my business at all or my profession at all. Then also I will get deduction. Okay, provided contribution is with a specific direction that it shall be used for by the recipient for scientific program approved by prescribed authority, deduction will be 100% of the contribution. Okay. Here category in 3 and 4 scientific R&D may or may not be related to assessee's business. We already discussed. And now in 35 category 2, 35(2)(ab), we had mentioned that it should be a company other than a company which is referred to in 35(1)(2)(a). 35(1)(2)(a) is this company which I already showed you. Now here all 4 categories combined together, which will be very difficult for you to read on the screen even if you zoom in, but you have the notes attached here with you. And 35 subsection 4 and 80 GGA. 35 subsection 4 says that if it is a capital expenditure under category 1 and 2, category 1 or category 2, and it remains unabsorbed, then it will be treated at par with unabsorbed depreciation and accordingly will be allowed to be carried forward for an unlimited period, just like 32(2) unabsorbed depreciation. If it is due to capital expenditure on scientific R&D, which could not be 35(1) clause 4 read with 35(2), both are one and the same, then it will be subject to 35(4). 35(4) says that it will be treated at par with 32(2). This is 35(2), this is 32(2). There is a difference. Don't psychologically jump to conclusion that both are same only. It will be treated at par with unabsorbed depreciation only with regards to capital expenditure, not with regards to revenue expenditure. Obviously, that much sense you should have. 80 GGA. Now, the section 35 deduction is allowed only to those people who have PGBP income. What about those people who don't have PGBP income and are contributing to IIT or National Laboratory, etc.? Then they will get deduction under chapter 6A under 80 GGA. 80 GGA, 100% will be allowed as a deduction. However, 80 GGA as well as section 35 as well as 80 GGA, most of them are not allowed for those who have opted for 115 BAA, BAB, BAC, BAD, BAE. Those people till BAE, these people cannot claim. What they cannot claim, I will tell you. 43(4) is the meaning of scientific R&D, which is not to be seen, and 41(3), which we will be discussing later, deemed profit. If asset acquired for scientific R&D is sold, then just the way we discuss for SLM depreciation and we discuss for telecommunication license fees, spectrum fees, same way here also, the asset, the cost of acquisition must have become 0. You acquired it for 100 lakhs, but because of deduction under section 35 of 100 lakhs, the cost of acquisition of this asset becomes 0. And now when it is sold, if sold for even 1 rupee also, then there will be profit. Entire sale proceeds will become profit. So in 41(3) we will discuss what if sold for acquired for 100 lakh, deduction claimed is 100 lakh. If sold for 40 lakhs, then what? If sold for 140 lakhs, then what? If sold for 40 lakhs, then minus cost of acquisition is 0. Entire 40 lakh will be your profit taxable under the PGBP. If sold for 140 lakh, cost of acquisition is still 0. Entire 140 lakhs is taxable. But now, out of 140 lakh, 100 lakh will be taxable under the PGBP and excess 40 lakhs will be taxable under the capital gain. Okay, that we will discuss when we come to 41(3). Okay, then we have 35 subsection 1A, which stated that all these people who are approved for this, for accepting your donation, you are contributing to them, they are approved college, university, approved company, university, college, research association approved under 35(1) clause 2 or a company referred to in 35(1) clause 2A. They will have to furnish at the end of the year, within 2 months, April and May, by 31st May of the next year, they will have to furnish one statement in form number 10 BD to prescribe income tax authority giving details of donations received by them or contribution received by them, and they will have to issue certificate in form number 10 BE to the donor certifying the donation. Then only donor will get deduction in his IT return, maybe under section 35 or maybe under section 80 GGA. Both these to be submitted, one to income tax department and one to be submitted, everything will be online only, on or before 31st May of the next year. Date need not be remembered, form number also need not be remembered, form 10 BD, 10 BE, those who have practical experience would be knowing about it. Otherwise, does not furnish, then there will be under 234G, there will be fees of 200 rupee per day of delay, plus there will be penalty under 271K ranging between minimum 10,000 to maximum 1 lakh rupee. This we will be discussing once again in assessment of charitable trust chapter, plus we'll be discussing in penalty chapter once again. Twice we'll be discussing it once again, so don't worry about anything. Proceeding further, so this statement furnishing and so is done. Now next is 35ED, which is important. 35ED, deduction for capital expenditure on 14 specified businesses. Which are these 14 specified businesses? Before that, let me tell you, here deduction is not allowed for 3 capital expenditure. We are not talking about revenue expenditure, we are talking about capital expenditure. It should be capital expenditure other than land, goodwill and financial instrument. Land, goodwill, financial instrument. What is financial instrument? Shares, debentures. In India, we call it as security, but this section seems to have been copy pasted from some foreign country. Therefore, we have used the word financial instrument, which is nothing but security. So, if you yourself are incurring, you yourself are doing these 14 businesses, then you are eligible to get the deduction optionally. But if you are not incurring, some company is incurring and you end up purchasing shares of that company, that will be financial instrument. You cannot claim deduction. For following 14 specified businesses, you just need to remember the names of these 14 specified businesses. Some of them are regularly asked. Number 1, laying and operating a cross-country pipeline network for distribution of natural gas, crude oil or petroleum oil. This deduction is allowed not to every person. This deduction is allowed to Indian company or consortium of Indian companies, group of Indian companies, or it is allowed to ABC. ABC, that is authority, board or corporation set up by or under any central or state act. Ideally allowed to Indian company or consortium of Indian company. Even the last one, developing, maintaining, operating and developing, operating, maintaining a new infrastructure facility. This deduction is also allowed only to company, that is Indian company, group of Indian company, that is consortium of Indian company, or it is allowed to ABC, authority, board or corporation set up by or under any state or state act or any central act. So the first one and the last one are allowed only to Indian company, consortium of Indian company and ABC set up under central or state act. Remaining 12 businesses, deduction is allowed to everyone, individual, HUF, AOP, BOI, company, firm, anybody. Cold chain facility is the next one. Then warehousing facility for storage of agricultural products, hotel of 2-star and above, hospital with 100 patient beds and more, housing project under slum redevelopment scheme, housing project under affordable housing scheme, new plant for manufacturing or production of fertilizer, or in case it is not a new plant but it is an existing plant where existing capacity of production is increased. There is an existing plant, there is a newly installed capacity in the existing plant for production of fertilizer, or inland container depot or container freight station, which you must have studied in customs in IDT, beekeeping or production of honey or beeswax, Baba Ramdev, honey or beeswax, Dabur honey, etc. There are a couple of companies which are into this, but this deduction is not allowed to everyone. In the sense, this deduction is allowed under this section only to those who newly start this business. So if any company is already into this business before the date of applicability of this section, so a company like Dabur is already into manufacturing of honey. Dabur is not doing any value addition to the society. They have already done. This deduction is only for those who now start with any of these businesses. Next is warehousing facility, but warehousing facility already discussed in point number 3, but that was agricultural warehouse, that is warehousing facility for storage of agricultural products. Now it is warehousing facility for storage of sugar. So we have 2 types of warehouses, one for sugar, one for storage of agricultural products. Sugar is not an agricultural product. Answer no, sugar is not an agricultural product. Sugar cane is an agricultural product. Sugar is manufactured out of it. If you consider sugar also as an agricultural product, then that way beer, wine, whiskey, everything will be agricultural product. Slurry pipeline network for distribution or transportation of iron ore, and semiconductor wafer fabricating manufacturing unit. Semiconductor, that means IC chip, integrated circuit chip, IC, integrated circuit chip. Okay, these 14 businesses, you don't have to memorize all of them, you just have to remember them on an overall basis. In exam, in question, they won't ask you a theory question asking you to describe all the 14 businesses. You just need to remember 3 prohibited assets: land, goodwill, financial instrument. Land, goodwill, financial instrument. And you also need to remember on an overall basis these 14 businesses. Once deduction is claimed under this section, then assessee will not get deduction under chapter 6A for that business. Assessee will not get depreciation also. These are not allowed to those, this deduction not allowed to those companies which have opted for 115 BAA, BAB, 22% and 15% tax rate. Individual HUF, AOP, BOI, AJP which have opted for new tax regime which is default tax regime under section 115 BSE or 115 BAD BAE for resident cooperative society. There is one clarification which is interesting, saying that if the purchase price, the cost of acquisition of the asset for which you are claiming deduction under 3580, payment is made otherwise by way of account payee check, account payee draft or electronic clearing services through bank, ECS through a bank other than APD, APC, EPA, ECS or other prescribed electronic modes, then simple language, payment is made by cash or bearer check or a cross check, then that much amount to be ignored for the purpose of 3580. Deduction will not be allowed. What does this mean? Meaning thereby, if the asset is acquired for let's say 100 lakh, out of 100 lakh, 1 lakh rupee token amount was paid in cash in one single day to one single person and balance 99 lakhs is paid by account payee check or account payee draft, then in balance sheet value will be 100 lakh but deduction under section 3580 will be only for 99 lakh. Okay. More than 10,000 in one single day to one single person, otherwise by way of account pay check, account pay draft, that much will be disallowed, to be ignored for 3580. Then interesting point and an important point, 3 assets are prohibited: land, goodwill, financial instrument. Land is prohibited but building is not prohibited, building is allowed. And very important point, pre-commencement period expenditure. Here, just like section 35 scientific R&D, we just checked it out, pre-commencement period expenditure is allowed but going backwards is allowed for maximum 3 years. Here no such restriction. Here capital expenditure is incurred otherwise other than on land, goodwill, financial instrument for the specified business before the commencement of business, maybe in the last 3 years or maybe beyond 3 years, then it will be allowed as a deduction. It will be allowed, it will be eligible, but not in the year of incurring the expenditure. It will be allowed as a deduction in the year in which business commences. Remember this very important point. Whenever a question has come from this section, it is always a practical question and these 2 points are always there. One is about land building, another is about pre-commencement period expenditure will be allowed in the year of commencement of business operations, provided the expenditure was capitalized in the books of accounts on the date of commencement of business. There are extra conditions also subject to exception. First is specified business should not be set up by way of reconstruction or splitting up of an already existing business. Same condition, splitting up, reconstruction of an already existing business. Same kind of conditions were there in section 10 AA also, SEZ, Special Economic Zone. Same conditions are there for 115 BAB, 15% tax rate for domestic company, and same condition for 115 BAE, 15% tax rate for resident cooperative society. We are done with them. Wherever this condition is there, the idea is that if Dabur which manufactures honey, Dabur is already manufacturing honey, this deduction is not meant for Dabur. So if Dabur manipulates and does demerger and creates a resulting company and transfers honey manufacturing business to resulting company will not become eligible to claim this 3580 deduction because it is reconstruction of an already existing business. Or there is amalgamation, Dabur amalgamates with this Baba Ramdev company, Patanjali. None of them will be eligible because they have already started off with this business prior to introduction of this section. Very important condition, second hand plant machinery not eligible. Second hand plant machinery not eligible, just like section 32 subsection 1 clause 2a, additional depreciation on new plant machinery. Second hand plant machinery. Remember, everywhere, wherever there is a condition with regards to second hand, prohibition with regards to second hand, it is always with regards to plant and machinery, no other asset. Building can be second hand, other assets can be second hand, furniture fitting can be second hand, but plant and machinery should not be second hand. Here, however, there are 2 exceptions. Okay, these 2 exceptions were not there. Which 2 exceptions? Number 1, if it is imported from a country outside India, and number 2, the second hand value, second hand plant machinery's value does not exceed 20% of the total value of all plant machinery in the given business. These are the 2 exceptions. These 2 exceptions are there for 115 BAB, 115 BAE, 10 AA and 35 AD. These 2 exceptions, 35 AD, these 2 exceptions were not there for section 32 subsection 1 clause 2a, additional depreciation. Additional depreciation, second hand not allowed means not allowed. Same way for 33 ABA and 33 AB, that is tea, coffee, rubber development account and site restoration fund account. These 2 places also second hand plant machinery not allowed from the amount withdrawn from reserve account. Funds have to be utilized by the end of the year, but second hand plant machinery, they are also not allowed, but no relaxation. So how many places there is a restriction on acquiring second hand plant machinery? Second hand plant machinery not allowed under 33 AB, 33 ABA, Tea Coffee Rubber Development, Site Restoration Fund Account, 10 AA, that is SEZ, 115 BAB, BAE, and even in 35 AD. Out of them, which all places there is exception? Not allowed, not allowed, not allowed, not allowed, not allowed. And exceptions, two exceptions, same two exception. Exceptions apply not for 33 AB and 33 ABA. Wait a moment. Here I should say yes, 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 yes. Second hand, not allowed. And exceptions are there only for 10 AA, BAB, BAE and 35 AD. Only for 33 AB, ABA. Oh, one more thing, 32 1 clause 2A. Most important. Exception is not there for that also. Additional depreciation on new plant machine. So 1, 2, 3, 4, 5, 6, 7 places there is a restriction on second hand plant machinery. Out of 7 places, only at 4 places there are exceptions. 2 exceptions, same 2 exception. Imported from a country outside India, provided it was not used by any person resident in India, blah blah blah. Okay, proceeding further. So first condition, it should not have been, new business should not have been started by way of splitting up or reconstruction of an existing business. Second is no second hand plant machinery subject to 2 exception. And last ordinary condition, audit of books of accounts and CA report along with IT return or 1 month before the due date of IT return. Once a deduction is claimed under this section, cost of acquisition of such asset will become nil, just like section 35 scientific R&D. If it is sold, then entire sale proceeds will be profit and will be taxable under the at PGBP. Here, understand, not a single rupee will go under the at capital gain. Taxable entirely under section 28 charging section of PGBP, entirely taxable under the at PGBP. Here, unlike section 35, in section 35, what did I tell you? If sold at a profit, so it has to be sold at profit only. No, section 35, entire cost of acquisition other than land building is allowed as a deduction for scientific R&D, section 35. If sold, cost of acquisition will be nil. Even if you sell it for 1 rupee, entire 1 rupee will be profit and will be under the head taxable under the head PGBP. Sometimes it can go under the head capital gain also. But here, nothing under the head capital gain, it has to entirely be taxed under the head PGBP only. Even if you acquired for 100, minus 100 deduction, cost of acquisition becomes 0. Now you sell it for 200, then also entire 200 taxable under the PGBP. Where is it mentioned? Answer, it is mentioned in section 28, the charging section. Next point is again important. Once you claim deduction under 35 AD, you cannot claim chapter 6A deduction for that particular business under heading C. Chapter 6A heading C will not be allowed. ATIA, IAB, ATIAC, IB, IBA, ATIC, ID, IE, ATJJA, JJAA, ATQQB, RRB, etc. You can claim ATC, ATD, ATG, all those will be allowed. No depreciation will be allowed, that is an important point, and no deduction under 10AA. This point I have covered in section 10AA chapter also. Either you claim 35 AD. Now see, 35 AD is to be claimed on a cost of acquisition of the capital asset. Cost of acquisition of the asset, of course, other than land, goodwill, financial instrument, but it is allowed as a deduction on the cost of acquisition of the asset, whereas 10AA and chapter 6A are allowed on the profit from that business. So either you make up your mind in the first year itself only, if you are eligible assessor, either you claim 35 AD, which is allowed in 1 year only in the first year, whenever you acquire the asset. Again, you acquire another asset for the specified business, again you can claim deduction, but right now you can claim deduction on the original cost of acquisition. Either you claim deduction under 35 AD or you claim deduction under 10AA or chapter 6A, whatever you are eligible for. You can't claim both. Double benefit should not be there. 35 AD subsection 7A and 7B, which you need to understand. Here, what some people were doing, for example, this is agricultural warehouse. I acquired agricultural warehouse, or let's say I acquired some building, huge building for 10 crore rupees in Mumbai, 10 crore rupees. Now this is for, let's say, coaching class. I purchased this building for setting up a coaching class, classroom I purchased. The coaching class is not one of the specified business. Therefore, I cannot claim deduction of 10 crore. I cannot claim 35 AD, the full 10 crore rupees, but I can claim depreciation under section 32, subsection 1. That will be allowed, right? But if I want full 10 crore rupees, then what will I do? Then on paper, I will show that this is not coaching class. On paper, I'll show that this is agricultural warehouse. It's a warehousing facility for storage of agricultural products. And then I will get deduction under 3580, full 10 crore I will get. Then I cannot claim depreciation. That is but obvious. But then I ended up claiming 10 crore. Then what I did, I attached CA report, CA certificate that okay, this year certified by CA that everything is correct. Next year or after few months or after maybe 1 or 2 years, I stopped using it for agricultural purposes or storage of agricultural products. I started using it as a coaching class center. Then what to do? For which deduction is not allowed. So initially when this section was introduced by Arun Jaitley, section was introduced by Chidambaram ji, not Arun Jaitley ji, Chidambaram ji, at that time he did not impose any restriction. He thought nobody will take undue advantage. But then when Arun Jaitley ji became finance minister, he realized that people can take undue advantage. So Arun Jaitley ji introduced some restriction, 35 AD subsection 7A, 7B, 7C. 7C is unimportant, so I have not covered in the revision notes. 7A, 7B, it says lock-in period of 8 years. It says once you acquire for a particular business, which is specified business, assessee needs to use the asset, use it for specified business only for next 8 years. Specified business only. Which specified business? Answer, maybe same specified business or maybe another specified business. Can be used for another specified business. Say I can convert it into hotel, no problem, within next 8 years. I can convert it into a hotel, I can convert it into a hospital, that is fine, but should not be used for non-specified purpose at any time within a period of next 8 years, starting with the year in which asset was constructed or acquired. If it is violated, then what will happen? Punishment. If violation is there, within 8 years, it is assessee starts using it for non-specified businesses or assessee ceases it to use it for specified business, violation will happen, then obviously something will become taxable. How much? The answer, whatever deduction was claimed in the first year or in the 0 year, year of acquisition, that deduction will have to be reversed. But then how much? 10 crore. 10 crore will become taxable. 10 crore will become taxable. But then government says not entire 10 crore, just like AMT chapter if you recollect. My benefit under 35 AD is not full 10 crore. If I have claimed 10 crore in the first year, my benefit is not 10 crore because by claiming 35 AD, I am compromising with depreciation. Say on building at the rate of 10%, assuming this is building, I would have got deduction of or depreciation to the tune of at the rate of 10%, I could have got it to the tune of 1 crore rupees. So by not claiming depreciation and claiming 35 AD, my benefit is only to the tune of 9 crore. So what will be taxable now in the year of violation of this 8-year lock-in period will be cost of acquisition minus notional depreciation only for 1 year. In this example, only for 1 year. If I started using it for non-specified purpose in the second year, 9 crore will be taxable. Supposing I started using it for non-specified business in a third year, that is after completing 2 years, then 10 crore minus depreciation of year 1, 1 crore, and also depreciation of year 2, whatever are the completed years, I converted it through or I started using that asset for non-specified businesses, non-specified activity in the third year. Third year I started, so how many years are completed? 2 years are completed. So a completed year depreciation would have been 1.9 crore. So now 8.1 crore would be the amount which will be taxable. So taxable amount will be 10 crore minus notional depreciation up till now for the completed year. Supposing I started using it for non-specified business in the fourth year, then I will claim notional depreciation of 3 years and only difference amount, balance amount I will have to add back under the PGBP. Loss from one specified business, this is important point, keep it in your mind. Loss from one specified business can be set off, this is homogeneous loss. Just like speculative loss, loss from one specified business can be set off only against profit from another specified business, otherwise carried forward. Here, carry forward period is unlimited. It can be carried forward as per section 73A by filing IT return. Unlimited period provided IT return is filed. IT return not filed, you can't carry forward. It will lapse. So, unabsorbed loss from the specified business. I am not saying loss due to deduction of capital expenditure. I am not saying loss because of 35 AD. I am saying loss from specified business will be allowed to be carried forward for an unlimited period. But even in the current year also and even in subsequent year also, it is a homogeneous loss can be set off only against no other income except of income from the same or another specified business. Balance, if any, carry forward for unlimited period. And then provisions of AMT will be attracted for those who have claimed deduction under 35AD other than company. Okay, so 35AD has always been an important section. Keep it in your mind. Nowadays, institute has started asking MCQ. Next is 35CCA, which is totally unimportant expenditure. Okay, payment for new PEF, NFRD, or payment to approved institution, payment to approved institution association, or NFRD, National Fund for Rural Development, new PEF, National Urban Poverty Eradication Fund. Okay, you are not spending money by yourself, you are making payment to these people. Approved association, which is approved till some 1984's data was given, which you need not study. You are making payment to these people so that they can carry out rural development program. Then you will get deduction under 35CCA. Deduction you will get, but not by incurring by yourself on urban poverty eradication or not for rural development. You don't do anything. You pass it on to these people will do it. If you have PGBP income, then you will get deduction under 35CCA, and you don't have PGBP income, you will get deduction under 80GGA. Next is 35CCC and CCD. Both are important, very small and one-liners, and they are important. 35CCC, both of them are 100% deduction of revenue expenditure as well as capital expenditure both. Here also capital expenditures are allowed, but for what? Here capital expenditure other than land building, here also other than land building. For agricultural extension project, 35CCC is for agricultural extension project, 35CCD is for skill development project. However, skill development project expenditure other than land building allowed only to company. Assessee should be company and not allowed if opting for 115BAA or BAB, right? Okay, these two are important. You need to remember 35CCD is allowed only to company, not allowed to individual HUF, AOP, BOI. However, even 35CCC and CCD, both of them will be disallowed if opting for 115BAA, BAB, BAC 1A, default tax regime, new tax regime, 115BAD, BAE, then deduction not allowed. But here only 115BAA, BAB because it's only for company. These two are important from exam perspective. 100% expenditure is allowed whether incurred for revenue or capital. If it is capital, it should be other than land building, both the places. In scientific R&D, it was section 35, the very first capital expenditures were possible only for category 1 and 2, self-spending, in-house research. In category 1, it was other than land, and in category 2, it was other than land building. And these two sections, again, other than land building, And 35AD, other than land, goodwill, financial instrument. Building is allowed, building is not prohibited. So everywhere, building is also prohibited along with land, but here, building is allowed. So keep it in your mind. 35D, preliminary expenditure. This used to be an important section at inter CA level. Final CA, it is less important. Preliminary expenditure means expenditure during pre-commencement period. In books of accounts, account subject, your first subject FR, there you call it as unabsorbed expenditure to the extent not written off, or whatever may be the name or whatever may be the nomenclature you might be calling it as. Here it is called as preliminary expenditure. Preliminary expenditure 35D, deduction is allowed at the rate of 20% per annum, 20% of total expenditure per annum into 5 years. But before we proceed further, understand what kind of expenditure it is. Preliminary, 9 expenditures are eligible. Preliminary expenditure means any of the 9 expenditures which are given here, which are divided into 2 categories. But now categorization is unimportant. Deduction could be with regards to starting with a new business, commencement of new business, then it is pre-commencement expenditure, or it could be expenditure. It will be called as preliminary even if it is incurred after the commencement of business, but before starting with or for starting with the new branch, or new unit, it is called as, they call it as unit, new unit or new undertaking, or for extension of existing undertaking. Extension means expansion. Instead of expansion, here in the act they call it as extension of the existing undertaking. Even if you're starting with a new business, then also pre-commencement period expenditure will be called as preliminary expenditure. And if you are incurring expenditure after the commencement of business, but to start with a new branch, new unit, new undertaking, then that will also be called as a preliminary expenditure. Expenditure incurred after the commencement of business, but before the commencement of operations of the new unit. Or for extension of existing undertaking, you have an undertaking factory with a production capacity of 1000 metric ton a day. Instead of that, now you are increasing your capacity to 1800 metric ton a day. So 800 is a existing capacity. You can say it is extended. It is new capacity is installed. Okay. Deduction will be allowed only to Indian company or resident non-corporates, meaning thereby it is allowed to all residents other than foreign company. Foreign company cannot claim it even if it becomes resident tomorrow. It is only for Indian company, not only for company, it is for non-corporates also. Individuals can also claim. HUF, partnership firm, LLP, everyone can claim, but everyone has to be resident. Indian company is always resident, you know pretty well, but then deduction allowed to other residents also, non-corporates also. Deduction, foreign company cannot claim. So if you want to write it down in bracket, you can write it down, foreign company not allowed, even if it becomes resident tomorrow. See, Indian company is always resident, foreign company may become resident or maybe non-resident. Deduction will be 20% of total of 9 eligible expenditure every year into 5 consecutive years. 5 consecutive years starting with which year? So 5 years starting with the year, in case if it is in connection with the new business, then 5 years starting with the year in which new business commences. In case you are incurring preliminary expenditure, 9 eligible expenditure for starting with a new unit or undertaking, then 5 years tick 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 will start from the year in which new undertaking or new unit commences its operations. Here new business is commenced, here new unit commences operations or new undertaking commences operation. But in case you are incurring for extension of the existing undertaking, then the question arises starting with which year? Answer, then in that case starting 5 years starting not from the year in which the extension starts, but 5 years from the year in which extension is completed. Everywhere else, whenever new business starts, commences, new unit commences operation, new undertaking commences operation, starts operation. But here, whenever the existing undertaking extension is completed or expansion is completed, that year. Starting with the year in which new business commences or the extension is completed or new unit, new undertaking commences production operation. Here, deduction 20% will be restricted to 5% of the cost of the project or 5% of capital employed, whichever is higher, 5% of the cost of the project or 5% of the capital employed, whichever is higher. What do you mean by cost of project? What do you mean by capital employed? Both are defined. Cost of project means purchase price, cost of acquisition of 7 specific assets. Which 7 assets? Out of them, first 6 are in the form of 3 pair. Land, building, which is 1 pair, plant machinery, which is the 2nd pair, and furniture fitting, that is the 3rd pair. Land, building, plant, machinery, furniture fitting, and the last one you will have to put in efforts to remember, railway sidings. Cost of acquisition of 7 assets, land, building, plant, machinery, furniture fitting, railway siding. And capital employed, we have one Supreme Court decision on which question has already come. Understand, capital employed would mean total of 3 things: issued share capital plus debentures plus long-term borrowings. Issued share capital plus debentures plus long-term borrowing. However, there is a clarification. See, assessee would always want to increase the amount of cost of project or capital employed. Higher the amount of cost of project or capital employed, higher will be the eligible amount of deduction while comparing with 20% of total expenditure. So, assessee would want to add more and more items here. So, in one of the cases, a public listed company, Berger Paints, matter went up to Supreme Court in the year 2017. Berger Paint added in the issued share capital, they considered share premium also or securities premium also. Assessing officer says share premium cannot be considered as a issued share capital. It's not paid up share capital, it is issued share capital, and issued share capital cannot include securities premium or share premium. Matter went up to Supreme Court. Supreme Court delivered a classy decision saying that issued share capital does not include share premium. Berger Paints 2017 Supreme Court. 35DD and 35DDA are also interesting. 35DD is very simple, expenditure on amalgamation or demerger. Here deduction is just like section 35D allowed to Indian company or cooperative bank. There can be amalgamation or demerger of only companies or at the max cooperative bank, not all cooperative society, only cooperative bank, which is called as business reorganization. Here, understand very clearly, there cannot be amalgamation or demerger of individuals. If two individuals amalgamate with each other, that can be called as a marriage. They separate from each other, then not demerger, it can be called as a divorce. Amalgamation can be only of two companies or at the max cooperative banks. They can claim deduction. How much? Again same 20% per annum of the total of such expenditure on amalgamation or demerger. However, starting with into 5 years, starting with which year? Starting with the year of amalgamation. Year of amalgamation or the year in which demerger takes place. How to find out in which year amalgamation has taken place? Answer, High Court will certify. High Court permission is required. The moment High Court certifies it, in its order, High Court will mention the date of amalgamation, starting with the year in which that date falls. Same way, 35 DDA, VRS expenditure, expenditure on voluntary retirement scheme compensation. It is also called as, instead of VRS, it is called, instead of voluntary retirement scheme, it is also called voluntary separation scheme. Both are one and the same only. Paid by employer to employee. Employer could be any person. Here it is allowed to all associate, unlike 35D and DD. See, 35D, double D, DDA, they go hand in hand. All three are allowed in installment, 20% per annum into 5 years. That's why they all three are considered as triplets. They are brothers of each other. Only difference is 5 years from which year. So in 35D, preliminary expenditure, 5 years starting with the year in which the new business commences or the extension is completed. 35 double D, 5 years starting with the year of amalgamation or demerger, and 35 DDA, 5 years from the year of payment. Here understand, payment. So in 35 ABA and 35 ABB, 35 ABA spectrum fees, 35 ABB telecommunication license fees. Here also, these two places also payment is a must. Telecommunication license fees. Here these two places deduction is based on payment. The year payment is made or the year in which business commences, whichever is later. Same thing for 35 DDA. Here also VRS compensation. Payment should be made, then only deduction will start. Deduction will be in 5 installments of 20% per annum, but starting with the year in which payment is made. 20% per annum, 5 years starting with the year in which payment is made. You need to remember this here, payment. So up till now, there have been 3 sections where the deduction is based on payment. Which 3? 35 ABA, ABB and 35 DDA. Okay. Employee will get exemption under section 1010C up to rupees 5 lakhs. Next is 35E, which is less important. 35E is allowed. 35 is allowed over a period of 10 years. Deduction is for 10 years. It is applicable to those people who are in the business of prospecting for extraction of or production of minerals. Prospecting for means searching for extraction of and production of minerals or development of mines or natural deposits. Deduction will be 10% of total expenditure into 10 consecutive years. 10 years starting with which years? 10 years starting from the year in which commercial production begins. Commercial production of minerals begins, which can be time consuming. Today you started digging and searching for it. Prospecting means searching for the minerals. You found it out, then you started extracting. And after extracting it, you take it to the factory. Factory, you make it pass through machines and chemical process. And after melting it and through chemical process, you remove impurities and convert it into a purified form. That is called production of minerals. So whosoever is into that business will get this deduction. Again here, this is deduction on account of pre-commencement expenditure. Expenditures incurred prior to beginning of commercial production. So ideologically it is pre-commencement period expenditure. Deduction will be 10% per annum, shall not exceed the income from commercial production for that year. Excess will be carried forward to the next year. What is this? This is the most important point. I will explain it to you. Before that, last point, look up here. 4 years. If you recollect pre-commencement period, how many years? How many years going backwards? So in case of 35 AD, 14 specified business, going backwards was allowed for unlimited period. In section 35 subsection 1 clause 1 and clause 4, scientific R&D category 1, there going backwards was allowed for 3 years, 3 years prior to the date of commencement of business. Here going backwards is allowed, but 4 years. Expenditure of last 4 years. See, current year onwards, expenditure incurred current year onwards will be allowed as a 100% deduction in the same year. Once the commercial production begins, thereafter whatever expenditure is incurred is going to be allowed otherwise also. Here we are talking about pre-commencement period expenditure before the commercial production begins, will be allowed in 10 installments over a period of 10 years, starting with the year of beginning of commercial production. But going backwards, how many years allowed? 4 years. Immediately preceding the year of commencement of commercial production or mineral are eligible for deduction under 35E. Let's try to understand these 2 points. So, which 4 years? First of all, 4 years immediately preceding the year of commencement of commercial production. So, supposingly expenditure is incurred year 1, year 2, 3, 4, 5, 6. 6th year is the year in which commercial production begins. Expenditure incurred is 180 lakhs, 20 lakh, 120 lakh, 200 lakh, 100 lakh and 60 lakh. So, once the commercial production begins, this expenditure will be eligible, 60 lakh. 60 lakhs will entirely be eligible. Even prior to that, going backwards 1, 2, 3, 4, 4 years. 20 lakhs, 120 lakh, 200 lakh, 100 lakh. Total how much? 300, 420, 440 lakh plus this 60. 500 lakh will be eligible. Total 500 lakh will be eligible. How many years? It will be allowed in installment for 10 years. 50 lakhs every year, starting with the year of beginning of commercial production. Clear? That was 35E. So 35D double D DDA. Of course, for 35D double D DDA, there is some common point that CS certificate has to be furnished or attached with the IT return in which deduction is claimed. CA report 1 month before the due date of filing IT return. And everywhere all these deduction, there is a clarification that no double deduction. Once you claim under 35D, same expenditure you can't claim in some other section. Once you claim under 35 double D, you can't claim it under other section. Same way for 35E also. That's it for now. In this video, we are recording the lecture till here. Next is 36.1 onwards 20 expenditure, which we will be discussing in part 2 of this video. Thank you very much. Till then, all the best. Wish you a good luck. Watch the video very carefully.